Welcome to the Deep Dive, the show where we cut through the noise and get straight to the essential insights.
Great to be here.
So we are kicking off a brand new week, July 21st, 2025. And the market, well, it's already signaling a pretty fascinating dance between, let's say, optimism and maybe some apprehension. U.S. stock futures are moving higher this morning, actually hinting that we might be, on the cusp of fresh record highs for both the S&P 500 and the NASDAQ.
Right, building on last week's momentum.
Exactly. This comes right on the heels of a solid winning week for Wall Street. S&P 500 up, 0.6%? And the NASDAQ climbed a pretty robust 1.5%. So what's really fueling this cautious optimism, and maybe what are the forces shaping the market right now?
Well, it's definitely a complex interplay. On one side, you've absolutely got the burgeoning earnings season. It's really hitting its stride and, so far delivering some quite impressive corporate performance. Yeah. And that's providing a much-needed sort of fundamental tailwind. But then on the other side, there's this very tangible, almost palpable risk coming from President Trump's looming tariff threats.
Right, the tariffs.
Yeah, creating significant headwinds and, frankly, a lot of uncertainty across global trade.
Absolutely. It really feels like a week where that fundamental strength, the earnings, could clash directly with the geopolitical tension from the tariffs.
Precisely.
So our mission today, as always, is to take a deep dive into these very forces. We'll look at the corporate earnings reports, the details, what they mean for valuations. We'll tackle those proposed shifts in global trade policy, and even some, surprising individual corporate stories that really highlight how interconnected everything is.
Yeah, how one thing impacts another.
Exactly. We're here to help you unpack what truly matters this week. So let's jump right in. Okay, let's start with what's providing that significant boost to market sentiment right now, the earnings engine room. We are well and truly in the thick of it.
Kicking into high gear, definitely.
Yeah. And this week alone, we're expecting reports from roughly 1 in 5 S&P 500 listed companies. That's just an enormous volume of fresh data coming at us.
It really is. It gives us a comprehensive look at corporate health across so many different sectors. It's a real moment of truth for a lot of businesses.
And the season so far, how's it looking?
It started with an impressively strong beat rate, actually. If you look at the S&P 500 companies that have already reported, that's about 11% to 11.5% of the index, maybe 62 companies as of the latest numbers.
Okay.
A staggering 85% to 86% of them have managed to beat Wall Street's consensus expectation.
Wow, 85, 86%. That's huge.
It is. It's not just a good start. Analysts are calling it a historically strong beat rate, especially, considering the expectations coming into this earnings season were, pretty modest by many accounts.
The historically strong beat rate off modest expectations. That's an interesting point, isn't it?
It is.
It suggests either analysts were maybe overly conservative, or perhaps companies have just gotten incredibly good at managing and then just slightly exceeding those expectations, even in this environment.
Could be a bit of both, right? Managing expectations is definitely part of the game.
Sure. But regardless, the overall picture, at least for now, points towards some decent growth. Second quarter earnings are currently tracking, 5% year-over-year growth after just the first week?
That's the number, yeah. 5% year-over-year growth so far.
So this brings up the big question for investors, doesn't it? Can this strong earnings season provide enough fundamental support to keep stocks trading up near these all-time highs? Or are market valuations getting a bit stretched, starting to attract those comparisons to historic tech bubbles, making them vulnerable if any bad news hits?
That's precisely the tightrope the market's walking. It's this constant tug of war between the, tangible fundamental strength we're seeing in corporate performance and those broader concerns about just how high valuations have gotten. It really requires a keen eye, I think, to distinguish between true sustainable outperformance and maybe what you might call low bar successes, beats that maybe aren't as predictive of future growth.
Right, separating the signal from the noise.
Exactly. And speaking of corporate performance, this week brings a whole slate of really well-known names into the earnings spotlight.
Yeah, kicked off this morning, actually. Before the bell Monday, we saw Domino's Pizza, ticker DPZ. They got the earnings party started.
And how did they do?
Well, it was quite a start, at least on the sales front. They reported a pretty healthy 3.4% rise in U.S. same-store sales for the quarter ending June 15th.
Okay, 3.4%. How did that stack up against estimates?
Comfortably beat them. Analysts were looking for about 2.21%, so solid beat there. And for Domino's, this was actually pretty significant because it marked their first U.S. same-store sales beat in 5 quarters. broke a long streak.
Oh, interesting. So a return to positive same-store sales growth, which is, such a key indicator for any restaurant chain.
Absolutely.
Did they say what drove it?
Yeah, they attributed the success to a couple things. First, they saw strong traction from new products like that Parmesan stuffed crust pizza they launched.
Ah, the new menu items.
Right. And second, they apparently appealed effectively to value-conscious consumers, which is obviously a growing group right now, by leveraging their rewards program.
Smart strategy, adapting to, consumer preferences and the economic pressures.
It certainly seems like it.
Yeah.
But here's the twist. Despite those strong top-line sales, their adjusted earnings per share actually fell short. Came in at $3.81 against a consensus estimate of $3.95.
Oh, so a miss on the bottom line.
A miss on EPS, yeah.
Yeah.
Though the revenue was pretty much in line at $1.15 billion. But here's the really interesting part. Despite that earnings miss, Domino's shares actually popped about 3% in pre-market trading.
Really? Up 3% even with the EPS miss.
Yeah. So how do we interpret that? Wall Street clearly focusing on the sales momentum over the earnings miss here. What does that tell us about current market priorities?
That reaction to Domino's is incredibly telling, I think. It really suggests that in this current climate, Wall Street is placing a premium on that top-line growth, on sales momentum, even if short-term profitability isn't perfectly aligned.
Right.
For you listening, this might signal a market that's maybe more forward-looking right now, betting on future potential, market share expansion maybe, over just the immediate incremental EPS beats.
So forgive a slight miss now if the growth story looks intact for the future.
Possibly. It implies investors might be willing to overlook a small bottom-line miss if a company can really demonstrate its ability to capture and retain customers and grow its revenue base, especially in a consumer discretionary sector like fast food. This could be a bit of a bellwether, for how other consumer-facing companies reporting this week might be received.
It's a crucial point. It's about signaling future strength.
Okay, so beyond Domino's, this week is just packed with other major companies reporting. We're talking big names, General Motors, the EV giant Tesla, of course.
Oh, the big one. American Airlines, the fast casual favorite Chipotle, and the tech behemoth Alphabet, Google's parent.
Yeah, and when we talk about tech giants, we cannot overstate the influence of the Magnificent Seven.
Sure.
These mega caps, including Alphabet and Tesla reporting this week, they play such a disproportionately critical role in driving the overall market performance. FactSet, for instance, expects the Magnificent Seven group to post, get this, 14% earnings growth in Q2.
14% for them.
14%. Compare that to the projected 3.4% growth for the other 493 S&P 500 companies.
Wow. That really paints a picture, doesn't it?
It really does. This concentration of growth within just a handful of companies underscores how much the overall market sentiment can just hinge on their individual performance.
It truly highlights that kind of two-tiered market we often talk about, where just a few behemoths dictate so much of the broader index's direction. And we're already seeing some early signs of this market selectivity this morning. Verizon, for example.
What happened with Verizon?
Their shares rose nearly 4% to 5% in pre-market. They comfortably beat their Q2 earnings expectations, reported $1.22 EPS on $34.5 billion revenue versus estimates of $1.18 on $33.74 billion.
Nice beat.
And they sweetened the deal by raising the lower end of their full-year profit guidance. That sends a strong positive signal.
Yeah, that guidance raise is key. That's a clear example of how exceeding expectations, even modestly, plus positive forward guidance, can really move a stock.
Definitely. Then there's Block, the fintech company, formerly Square.
Yes, Block. What about them?
Their stock soared, an impressive 9 to 10% in pre-market trading.
Wow, why the big jump?
News broke that they're being added to the S&P 500 index on July 23rd. They're replacing Hess Corp.
The index inclusion effect.
Exactly. But it's more than just a stock move, isn't it? It feels kind of symbolic. It signifies fintech, digital payments, really moving into the mainstream of financial services, cementing their importance.
Absolutely. It's a significant milestone for that whole sector. Really legitimizes it within the broader market structure.
For sure. Meanwhile, on a completely different track, we've also seen Opendoor, the online real estate platform.
Opendoor, right. They've been volatile.
Incredibly.
Yeah.
Continuing what some are calling a retail frenzy. The stock gained over 180% last week.
180%.
Yeah, and then tacked on another 28% in pre-market trading this morning.
Good grief. What's driving that? Fundamentals.
Doesn't seem like it's primarily fundamentals. It appears fueled more by just enthusiastic retail investor buying, maybe some short squeezing, coupled with a bullish case put out there by an activist investor.
Ah, the retail army and activist combo.
Yeah, it's a really interesting contrast to the more fundamental earnings stories. Highlights the impact of those speculative retail flows and, activist capital.
It definitely shows how completely different market forces can drive wildly different stock movements at the same time. But while some stocks are, shooting for the moon, others are facing pretty significant headwinds, often unrelated to their core business. Look at Sarepta Therapeutics.
Right, that drug maker. What happened there?
Their shares fell over 10% this morning.
Ouch. Why?
The company announced it would refuse to comply with the FDA's request to halt shipments of its muscular dystrophy drug, Elevidys.
Refuse an FDA request. That sounds serious.
And it is, and the drug has unfortunately been linked to 3 patient deaths.
Oh, wow. Okay. That's a profound reminder that these non-financial risks, regulatory risks, ethical considerations, they can have immediate and dramatic impacts on a company's valuation, regardless of its balance sheet.
Absolutely. So you have this incredibly dynamic, sometimes paradoxical picture right now. Generally strong earnings setting a positive underlying tone, but also these very specific, sometimes dramatic movements driven by just a whole variety of factors. Index inclusions, retail speculation, regulatory battles. It's a lot to track.
It really is. Okay, let's zoom in now on a company that consistently grabs headlines, especially around earnings. Tesla, ticker TSLA.
Always a must-watch.
Absolutely. This week, we're watching Tesla's tightrope walk very closely. They're balancing expectations around their Q2 earnings due Wednesday after the bell.
Right.
The, let's say, unpredictable influence of CEO Elon Musk, and some pretty significant external headwinds.
Yeah, a lot going on there. So what are the key metrics for Q2 earnings? What should people be watching?
Well, from a financial perspective, Bloomberg estimates put Tesla's Q2 revenue at about $22.79 billion.
Okay, $22.79 billion. How does that compare?
If it's accurate, it would actually be a notable 9% drop year over year. They did $25.05 billion in Q2 last year.
A 9% drop. That's quite significant for a company usually associated with high growth.
It is. And adjusted earnings per share are projected around 0.43 cents, which is also slightly down from a year ago. And it's crucial for investors to remember, despite all of Elon Musk's grand futuristic visions, the robots, the AI.
The robo-taxes.
Exactly. The core auto business remains the primary, almost the sole driver of Tesla's actual revenue and profit right now. That's really where the market's main focus is going to be.
Absolutely. Got to focus on the fundamentals of the car business.
That's right. And speaking of that core auto business, global deliveries are a major point of concern and a big reason for that projected revenue drop.
Yeah, the delivery numbers weren't great, were they?
No. Tesla delivered only 384,122 vehicles globally in Q2. That marks a pretty substantial 13.5% year-over-year decline.
13.5% drop. Ouch. Is that demand or production issues?
Well, that's the key question, isn't it? This downturn might be partly attributed to the recent changeover to the refreshed Model Y.
The production ramp for the new version.
Exactly. So the critical question for management on the earnings call will be about the availability and a production ramp-up of that new Model Y in its main selling regions like the U.S. and Europe.
Right. Is this slowdown truly just temporary production bottlenecks during the refresh? Or is it a more worrying sign of, softening underlying demand for their cars?
That distinction is absolutely paramount for investors. If it's just production, that's a temporary issue they can fix. If it's weakening demand, well, that's a much more fundamental challenge, isn't it?
Huge difference. And beyond just the raw numbers, Tesla faces this whole confluence of significant challenges and external headwinds right now.
Like what?
Well, one notable and kind of unique factor is the impact of Elon Musk's own political activities and pronouncements.
Oh, the Musk factor.
Yeah. His often, let's say, rocky relationship with figures like President Trump, for example, is demonstrably, according to some analysts, taking its toll on the optimism that fueled Tesla's big stock run in late 2024.
So investors are getting wary of the kind of non-business controversies potentially affecting the company.
Increasingly so, it seems. And here's where it ties directly into one of our main topics today.
Yeah.
Those looming tariff policies.
Right, the Trump tariffs. How do they specifically hit Tesla?
Well, these potential tariffs, which we'll definitely dive into more deeply, could significantly impact EV sales and production costs for Tesla. Remember, Trump's past tariff war historically led to, broad-based selling in the market and fears of a global economic slowdown.
Yeah, I remember that volatility.
And that kind of environment could certainly make things tougher for Tesla's global operations and sales, especially given they have manufacturing in the US, China, Germany. Any additional friction at borders means added costs and potentially makes them less competitive.
Makes sense. More border friction equals more cost.
Precisely. Add to that the sort of pervasive softening of global EV demand, which is particularly evident in key regions like Europe right now.
And sliding U.S. sales too, right?
And sliding U.S. sales. Both are ongoing issues. Furthermore, the landscape for electric vehicles has just intensified dramatically. You've got the rise of better competition.
Yeah, the legacy automakers are catching up.
They're catching up fast with their EV strategies, and you've got new agile players entering the market with really compelling alternatives that offer consumers more choice and often more competitive pricing.
And didn't we see something about consumer preferences shifting a bit too?
We did. Let's not forget the noted shift in U.S. consumer preferences. While pure battery electric vehicles, like Tesla makes, were once seen as the undisputed future, there's a noticeable pivot among some consumers back towards hybrid vehicles. They offer that kind of bridge between traditional engines and full EVs.
And that poses a challenge for Tesla, which is pretty much all in on pure BEVs.
Exactly. Diversification in powertrain offerings is something many of their competitors now boast, which Tesla doesn't have.
So, okay, lots of challenges in the core auto business, which inevitably brings us to
Robotaxi.
robotaxis, one of Elon Musk's most ambitious and maybe most controversial big bets.
Yeah, this could be a really significant focus during the earnings call. Musk might give more concrete details about future rollout plans.
Where do things stand with that now? I know they started testing in Austin.
They did. Tesla has expanded its robotaxi testing in Austin, Texas. Reports suggest a larger operating area now, and more vehicles are expected to be deployed soon.
And Musk mentioned San Francisco too, right? A much tougher environment.
He did mention expanding testing to the San Francisco Bay Area, which would be a huge step. But importantly, reports suggest that the formal permit applications needed for that kind of expansion haven't actually been submitted yet.
Ah, okay. So, talked about, but permits not filed.
Seems that way. And while the initial Austin test did begin roughly on time, around mid-May, as Musk proposed, it's really important to put Tesla's robotaxi efforts into the competitive context.
Right. Who else is playing big in that space?
Well, Alphabet's Waymo, for instance, is widely seen as a leader in autonomous driving. They have years more data, significant expansion of actual robotaxi deployments across multiple U.S. cities already.
Okay, Waymo's way ahead then.
Arguably, yes, in terms of current deployment and experience. And Uber is also actively pursuing similar initiatives with its tech partners, building out its own autonomous capabilities.
So Tesla's vision is captivating, but they're not operating in a vacuum.
Not at all. They still have, frankly, significant ground to cover to truly compete with, let alone surpass, these established players in a highly complex and crucially highly regulated sector.
Yeah, regulation is a huge hurdle.
Massive. So the underlying question for investors listening is, how much of this robotaxi bet is a viable, maybe near-term future path for Tesla? And how much is potentially a distraction from the more immediate, pressing challenges facing that core auto business?
That's the tension, isn't it? The grand vision is definitely there. It captures headlines, no doubt. But the immediate execution, the regulatory hurdles, the competitive realities, that's what investors are really scrutinizing this week.
Exactly. It's that classic case of balancing future promise with present-day challenges.
Okay, let's shift gears now. Let's talk about what could easily be the biggest market mover this week, maybe even this month, the looming tariff tsunami.
Yeah, this is huge.
We're talking about President Trump's August 1st hard deadline for implementing these new, broad, and remarkably steep levies on a whole range of goods. This storm's been brewing for months, and it really looks like it's about to hit landfall.
That August 1st date, it's been firmly and pretty unequivocally reaffirmed by Commerce Secretary Howard Lutnick.
What did he say exactly?
He stated quite clearly, and I'm quoting here, that the new tariff rates will come in on August 1st. And he added, nothing stops countries from talking to us after August 1st, but they're going to start paying the tariffs on August 1st.
Wow, that sounds pretty final, like a line in the sand.
It sends a very strong signal, doesn't it, that the administration intends for this deadline to be non-negotiable.
It certainly sounds incredibly firm, almost like an ultimatum. But you know, there is a history here, right? President Trump's tariff deadlines have shifted before. Remember back when he first announced this on April 2nd? The dates moved around a bit.
That's true. There have been shakes in the past.
So it makes you wonder if Lutnick's statement, despite how firm it sounds, might be, well, more bark than bite. Or at least maybe still open to some flexibility given those past precedents.
It's possible. And adding to that complexity, Treasury Secretary Scott Bessent offered another layer of nuance just recently.
Oh, yeah? What did Bessent say?
He said that the administration is, and I quote, more concerned with high-quality deals than getting these deals done by August 1st.
Ah, okay. So quality over speed. That sounds a bit softer.
A little. He even hinted that Trump himself would ultimately decide if deadlines could be extended, but only for really productive talks. But, and this is a big stew, but he also warned that higher tariffs might apply if talks boomerang or go sideways.
So it's kind of a mixed message then. Keep talking productively, maybe get an extension, but if not, face the music. Maybe even worse music.
Exactly. It feels perhaps intentionally designed to keep trading partners on edge, engaged in negotiations, but under serious pressure.
That shifting rhetoric must create immense uncertainty, though, for trading partners, for financial markets.
Yeah.
Just makes it so hard to predict the outcome.
Absolutely. What is unequivocally clear, however, is Trump's aggressive tariff approach and just the sheer breadth of his global targets. He's proposed sweeping 15% to 40% blanket tariffs.
15 to 40% across the board.
Potentially. And he's already sent formal letters to over 20 trade partners outlining these new baseline tariff levels. For Brazil, for example, the proposed rate could be as high as an astonishing 50%.
50% for Brazil. That's almost prohibitive. That could just completely disrupt trade flow.
It's massive. And beyond that, he specifically announced a huge 35% tariff on Canadian goods.
35% on Canada, our biggest trading partner. That would surely strain relations.
Undoubtedly. And he's also promised 30% duties on imports from Mexico and the entire European Union.
30% on the EU, too. Wow.
Yeah. And for over 150 smaller trade partners, the proposed rate could be 10% or 15%. Plus, it's not just these broad-based tariffs. He's also reportedly considering potential sectoral levies.
On specific industries.
Yeah, on crucial materials like copper, vital pharmaceuticals, key components like semiconductors. It's really a comprehensive challenge to the existing global trade framework.
And how have these letters, these proposals been received?
Well, they've effectively upended months of careful negotiations that were already ongoing. Trump reportedly views these letters and the terms within them as essentially the deals themselves.
So take it or leave it, kind of.
Seems to be the initial stance, although he's also indicated some openness to different agreements if countries come back with them. It's a highly unconventional, some might say disruptive, negotiation style that's left many countries just scrambling to figure out how to respond.
And scrambling they must be, particularly the European Union, I imagine.
Oh, absolutely. The EU is not taking this lightly at all. They are actively preparing stringent measures to retaliate against U.S. companies if a comprehensive trade pact doesn't materialize before that August 1st deadline.
Retaliation. What kind of measures are they considering?
Well, EU officials are actually meeting this very week specifically to draw up a detailed, unified plan for these reprisals.
Okay, so they're getting organized. What's on the table?
Their proposed actions are pretty significant. They include potential levies on over $100 billion worth of U.S. goods.
$100 billion worth? That's substantial.
It is. But it also extends beyond just physical products. It could encompass restrictions on U.S. digital services, for instance, imposing a levy on advertising revenues generated by American tech giants within the EU.
Hating big tech's ad money.
Could be. They're even considering curbs on American companies' access to the EU's lucrative public procurement market. Winning government contracts in Europe could get much harder for U.S. firms.
That would be a significant blow. And I heard something about a new, powerful tool they might use.
Yes, that's particularly notable. Germany, Europe's largest economy, often a more cautious voice, right?
Usually, yeah.
They're reportedly aligning with France now in considering the use of the EU's so-called anti-coercion instrument.
Anti-coercion instrument. What exactly is that?
Think of it as a legal shield and sword rolled into one. It allows the EU to impose countermeasures like tariffs, trade restrictions against non-EU countries that try to bully them economically or interfere politically.
And they haven't used it before.
Never been used before. It's described by many as the bloc's most powerful trade weapon. The fact that they're even publicly discussing using it tells you just how seriously they're taking Trump's threats.
Wow. So Trump's hardline push might actually be backfiring by unifying the EU against him.
That seems to be the dynamic. His aggressive push for these higher baseline tariffs, minimum 15 to 20%, reportedly has actually had the perhaps unintended effect of stiffening the EU's resolve.
Interesting.
Despite their stated preference to keep negotiations on track for an agreement, these tactics have made them more determined to prepare for a potential trade war. It's a clear example of how aggressive tactics can sometimes harden the opponent's stance.
Fascinating dynamic. And it really highlights the interconnectedness of everything, doesn't it? I even saw reports about the EU stalling its probe into Elon Musk's X platform.
Yeah, that was interesting. This seemingly unrelated regulatory action into X, the social media platform, was possibly delayed specifically to avoid further offending Trump and escalating these transatlantic trade conflicts.
So a regulatory probe gets put on hold because of trade tensions.
It highlights exactly how broader political and trade considerations can influence and even freeze completely unrelated regulatory actions. It's all tangled up, as one official apparently put it, in a complex web of geopolitics.
Incredible. Anything else on the EU front? Maybe specific sectors?
Well, from an automotive perspective, there's an interesting plea from the CEO of Volvo Cars.
Volvo. What did he say?
He publicly urged the EU to cut its own existing 10% tariff on American-made cars imported into Europe.
Really? Cut their own tariffs. Why?
He argues that European automakers are competitive enough, they don't actually need this protection, and that the EU should lead by example on free trade.
Interesting stance from within the industry.
It is. Meanwhile, Brussels has been trying, with little success so far, to persuade Washington to lower its own existing, much higher, 27.5% tariff on European cars coming into the U.S.
Right. That 27.5% U.S. tariff on EU cars has been a sore point for years.
Exactly. It highlights a long-standing asymmetry in auto tariffs that actually predates Trump's recent threats, but just adds another layer of complexity to these already fraught negotiations.
Okay, let's move beyond the political rhetoric and the negotiation tactics. Let's delve into the real-world impact of these tariffs, because it's not just numbers on paper. It profoundly affects actual businesses, their supply chains, and ultimately us, the consumers.
Absolutely. This is where the rubber meets the road.
Take Stellantis. The major automaker merged Fiat Chrysler and PSA Group. They recently issued a really stark warning.
What was the warning?
A staggering $2.3 billion, that's about $2.7 billion, projected net loss for the first half of 2025.
A $2.7 billion loss. Wow. Due to tariffs.
Partly, yes. They attributed it partly to an initial $300 million hit, specifically from U.S. tariffs. That directly led to lower shipments out of North America and forced them into production cuts.
So tariffs directly causing lower sales and production cuts.
It seems so. Their North America shipments, a crucial market for them, declined by a significant 25% year-on-year in Q2. This just underscores the immense challenges facing their new CEO, Antonio Filosa. He's inheriting a company already grappling with these major trade headwinds.
That really illustrates the direct, immediate financial consequences for these large multinational corporations caught in the crossfire.
For sure. But the impact isn't just limited to giant manufacturers, is it?
Not at all. Consider retail executives across the country right now. Reports say they are actively sweating the upcoming holiday shopping season.
Sweating the holidays already. Why?
Because months of confusion and uncertainty over these fluctuating tariffs mean they literally don't know which products. Think about everything from kids' toys to artificial Christmas trees will be available for sale, or more importantly, at what cost.
The cost uncertainty.
Exactly. This dramatically complicates their planning. Retailers typically finalize holiday orders and pricing by, the end of June. Imagine trying to set your prices and order your inventory when your import costs are a complete moving target.
It sounds like a logistical nightmare. Must directly hit their profitability and eventually consumer prices too.
Absolutely. And here's a really surprising ripple effect, a true example of unintended consequences: Hawaiian coffee growers.
Hawaiian coffee, how are they affected? They're domestic producers, right?
They are. They don't import coffee. But these farmers fear that tariffs on major exporters like Brazil will actually hurt them too.
Okay, walk me through that. How does a tariff on Brazilian coffee hurt a Hawaiian farmer who isn't directly competing with those imports on the shelf?
It's a classic case of what economists call demand elasticity and just market psychology. If Brazilian coffee, which is a massive global commodity, suddenly becomes significantly more expensive due to tariffs,
Hmm.
consumers might just cut back on their overall coffee consumption. Maybe they drink less, maybe they switch to tea or something else entirely, rather than automatically just paying more for a pricier domestic alternative like Hawaiian coffee.
So overall coffee demand shrinks.
Yeah.
Demand destruction.
Exactly. That phenomenon, demand destruction, hits the entire category. It puts downward pressure on prices, even for untariffed local products, because the overall market for coffee shrinks or just becomes way more price sensitive.
Okay, that makes sense.
Plus, rising prices signal broader economic headwinds, which can reduce overall consumer spending power. That impacts all discretionary purchases, including premium items like Hawaiian coffee. It's a domino effect that extends far beyond the initially targeted goods.
That's a really profound insight into the broader economic impact. It's not just about the targeted item. Okay, what about direct hits on raw material producers?
We're seeing that too. Alcoa Corp, the largest U.S. aluminum producer.
Right, Telco.
They recently claimed that tariffs on Canadian aluminum imports cost them a substantial $115 million in Q2 alone.
$115 million in one quarter just from Canadian aluminum tariffs.
Yeah, and that's a significant jump from the $20 million hit they reported in Q1.
Wow.
Similarly, Rio Tinto Group, another mining giant, reported over $300 million in costs for its Canada-made aluminum just in the first half of this year due to these same tariffs.
$300 million. These are not minor inconveniences. These are hundreds of millions of dollars directly hitting the bottom line of major producers.
Absolutely not minor. And finally, a very specific but really illuminating example, graphite tariffs.
Graphite, what's the story there? Used in batteries. Right?
Exactly, a key material for electric vehicle batteries. The U.S. recently imposed preliminary anti-dumping duties of 93.5% on graphite imports, specifically from China.
93% anti-dumping duty, on top of existing tariffs.
Yep. When you combine it with existing rates, it makes the effective tariff on Chinese graphite somewhere around an astonishing 160%.
160%. Why so high?
Well, this particular trade policy aims to counter what the U.S. views as unfair subsidies from the Chinese government for their graphite producers.
Okay, so targeting subsidies. What was the market reaction?
Immediate and dramatic. Stocks of non-Chinese graphite miners just surged. Sierra Resources jumped an incredible 38%. POSCO Future M climbed 24%. Novonix rose 21%. Nouveau Monde Graphite also saw a significant 21% jump.
Wow. So the tariffs on China directly boosted competitors elsewhere.
Instantly. It perfectly illustrates how highly targeted trade policy can drastically reshape specific sectors and their supply chains almost overnight. It rewards companies operating outside the targeted regions and aims to foster new domestic or allied supply chains.
Definitely highlights the profound, almost immediate impact of these targeted actions, especially in critical sectors like EV batteries, where supply chain resilience is becoming so important. So we've navigated the big picture on earnings and that looming tariff storm. But underneath these major macro themes, individual companies are making really interesting strategic moves, and global power plays are unfolding, often with surprising implications. Let's maybe delve into Couche-Tard's recent pivot, for instance.
Yeah, this is a really classic example of a large multinational company reacting swiftly and decisively to a major strategic setback.
Couche-Tard, they're the parent company of Circle K convenience stores, right? Big player.
Huge player. Canada's alimentation Couche-Tard, market cap around, $16 billion. They officially announced they would resume their share repurchase program.
Okay, resuming buybacks.
Yeah.
Why is that significant now?
Because it comes just days after they publicly scrapped their massive $46 billion attempt to acquire Japan's 7 & I, the operator of 7-Eleven.
$36 billion. That was a huge deal they were going for. What happened?
Apparently, the Japanese retailer 7 & I refused to engage constructively on the deal, according to Couche-Tard. So Couche-Tard just walked away.
Okay, so a massive, potentially transformational acquisition bid falls through. What was the immediate market reaction to Couche-Tard walking away? You'd think maybe negative.
Counterintuitively, no. Couche-Tard's stock actually closed up a strong 8.3% on July 17th, the very day they announced ending the acquisition talks.
Up 8.3% after killing a huge deal. That's a powerful signal, isn't it?
It's an incredibly clear signal.
What does that tell us about investor sentiment when a major deal collapses like that?
It tells us that the market, in this specific instance, clearly preferred strategy discipline and smart capital allocation over maybe prolonged uncertainty or potentially overpaying for a huge, complex deal.
So the market didn't like the deal in the first place.
Possibly. The stock had been down about 5% year to date before they killed the deal. which likely reflected some investor skepticism about the acquisition attempt itself. When the deal was terminated, investors seem to have interpreted it as a sign of financial discipline and strategic focus, rather than, a failure.
Okay, makes sense. And the buyback reinforces that.
Absolutely. Their new strategy reinforces this pivot perfectly. An authorized share buyback program starting July 23rd, running for 2 years, allowing them to buy back up to 77.1 million shares valued at roughly $4.2 billion.
$4.2 billion in buybacks, that's significant.
Very significant. It unequivocally signifies a pivot away from that aggressive external expansion strategy towards directly boosting investor confidence and shareholder value through major capital returns. It's a textbook example, really, of a company choosing to return capital directly to shareholders when a perceived growth opportunity proves too elusive or maybe just too expensive.
It truly is a textbook case of pivoting to maximize shareholder value when Plan A doesn't work out. Okay, now let's talk about a real corporate chess match brewing in the golf world, of all places.
Ah, yes, the TaylorMade tug of war.
Exactly, between two pretty significant players, Korean fashion brand F&F Co. and the private equity firm Centroid. This sounds like it has all the makings of a high-stakes legal drama.
It really does. It's a fascinating story that highlights the intricate complexities and, frankly, the potential pitfalls in these large private equity deals and strategic investments.
So set the stage. Who are the players again?
Okay, you've got Korean fashion brand F&F Co. They own brands like Discovery Expedition, MLB apparel licenses in Asia, pretty big deal over there. They've actually hired Goldman Sachs to advise them on a potential acquisition of TaylorMade, the globally famous golf equipment brand.
Okay, so F&F wants to buy TaylorMade. But what's the tug-of-war part? Who owns TaylorMade now?
Right now, TaylorMade is owned by Centroid Investment Partners, a Korean private equity firm. They bought it back in 2021. But here's the crucial twist. F&F wasn't just any investor in Centroid's original 2021 acquisition of TaylorMade.
Oh, they were involved back then.
They were the largest equity investor in that deal. F&F contributed a substantial 358 billion won, that's about $258 million to help Centroid buy TaylorMade in the first place.
Okay, so F&F put up a lot of the money for Centroid to buy TaylorMade initially. And now F&F wants to buy the whole thing themselves.
Exactly. But here's where the plot really thickens. F&F claims that as part of their original investment agreement back in 2021, they secured specific rights, namely written consent rights over key management matters, including equity sales.
Consent rights over selling the company. Okay, that sounds important.
Very important. And even more crucially, they claim they secured a right of first refusal, often called an ROFR.
A right of first refusal. Explain what that means in this context.
An ROFR is a really powerful contractual clause. It essentially means that if the current owner, Centroid, finds another buyer for TaylorMade and agrees on terms to sell,
Yeah.
F&F has the legal right to step in and purchase TaylorMade themselves, matching the exact same terms offered by that third-party buyer.
Wow. So they get the first crack at buying it, essentially blocking any other sale if they want to match the price.
Precisely. It's not just about money, it's fundamentally about control over the asset's destiny. An ROFR can dramatically complicate, delay, or even completely block a sale process. It gives the holder, F&F in this case, immense leverage.
Okay, so F&F has these alleged consent rights in this ROFR. What's the conflict now?
The conflict is that Centroid is apparently trying to sell TaylorMade now, potentially to someone else, for maybe as much as $3.5 billion. And F&F is stating unequivocally that it has not consented to Centroid's current effort to sell TaylorMade.
Ah, so they're saying Centroid is trying to sell without the required consent.
Yes, and they view this attempted sale as a significant breach of its contractual consent rights. This isn't just a simple disagreement, it's a direct allegation of Centroid breaking a legally binding contract.
And are they threatening legal action?
Oh yeah, they are clearly not holding back. F&F has stated publicly they are methodically preparing to exercise our right of first refusal and are, quote, fully prepared to deploy all available legal and contractual measures to hold Centroid accountable for its violations.
That sounds like lawyers are definitely getting involved. Very strong language.
Extremely strong. It signals an impending, likely messy legal battle. Centroid, for its part, has simply confirmed it is undergoing a process of selling TaylorMade to maximize its LP's return on investment. You know, standard PE talk.
Maximize returns for their investors, yeah.
But this situation really highlights the complexities, doesn't it? The potential legal fights that can erupt in these big PE deals and strategic investments, especially when control provisions and exit rights like ROFRs and consent rights are disputed down the line.
It's a powerful reminder that it's not always about who has the biggest checkbook or the best offer right now.
Yeah.
Sometimes it comes down to who signed what agreement years ago and the specific fine print in those contracts.
Absolutely. The ultimate determinant can be buried deep in those legal documents. It's a compelling look at the less visible, but equally important strategic moves and intricate legal battles that can profoundly shape the future of major, well-known brands like TaylorMade.
Okay, so we've really covered a lot of ground. We've navigated the explosive start to earnings season, delved into Tesla's unique challenges and opportunities, examined that looming tariff storm and its very real-world impacts, and even explored some of these intricate corporate chess moves and potential legal battles, like with Couche-Tard and TaylorMade. Now, let's try to connect all these dots, synthesize the bigger picture for you, our listener, our learner.
Yeah, let's bring it all together. The overall market sentiment right now, it really is this fascinating and, frankly, delicate balancing act.
Yeah.
Well, while there's undeniable optimism being fueled by the strong performance we're seeing from many S&P 500 companies, particularly big tech in their early earnings reports.
Right, those strong beats you talked about.
But that August 1st tariff risk remains a significant, almost like a dark cloud, just hanging over the market. Futures for the major indices, S&P 500, NASDAQ, Dow, they're up slightly this morning, but that slightness kind of indicates a degree of caution amidst the gains rather than, unbridled exuberance.
Cautious optimism seems like the right phrase then.
I think so. And we're also awaiting the June reading for leading economic indicators today. Those are crucial predictive metrics for the overall market and economy, and they'll provide another important piece of this puzzle.
Okay, so what does all this mean for you, the informed learner trying to stay ahead? Let's maybe distill some key takeaways from everything we've discussed.
Good idea.
First, maybe obvious, but worth stating. Brace for volatility ahead. That August 1st tariff deadline is a truly critical inflection point. It could introduce significant market swings, up or down, depending on how it plays out.
Yeah, uncertainty equals volatility.
Exactly. And understanding the nuanced statements from U.S. officials differentiating between that hard deadline rhetoric from Lutnick and the possibility of continued negotiations mentioned by Besant, that's going to be key to interpreting how the market might actually react moment to moment.
Right. It's not just if the tariffs hit, but how the rhetoric around them evolves, whether any 11th hour compromises emerge. That uncertainty is what the market hates.
Precisely. Second key takeaway.
I'd say the sheer interconnectedness of global affairs. We've seen so many examples today. Observe how seemingly disparate events can ripple through financial markets and corporate strategy in unexpected ways.
Like what? Give us some examples again.
Well, think about how Domino's sales beat, even with an EPS miss, signaled a market may be prioritizing future momentum. Or how the EU potentially stalling its probe into Elon Musk's X isn't just about tech regulation, but a strategic move linked to avoiding trade conflicts.
Right, the geopolitics influencing regulation.
Yeah. Or the direct impact of tariffs on a giant like Stellantis, forcing production cuts. Or even that surprising ripple effect on domestic industries like Hawaiian coffee growers who weren't even directly targeted.
It really demonstrates how intertwined politics, consumer behavior, corporate strategy, global trade, it's all linked.
Deeply intertwined. Global events can influence seemingly isolated businesses in ways you wouldn't immediately expect.
Okay, third takeaway, corporate agility.
Yes, crucial. Companies like Couche-Tard really demonstrate how quickly and effectively corporate strategies can pivot and sometimes need to pivot in response to major events like a big deal failing.
Yeah, shifting from that huge acquisition attempt to massive share buybacks almost overnight.
Exactly. They shifted from pursuing complex external growth to prioritizing direct shareholder value. That kind of strategic flexibility, that ability to change course, is absolutely crucial for companies trying to navigate today's dynamic and, frankly, unpredictable global environment.
It's about recognizing when a path isn't working and having the foresight and the discipline to actually change course, right?
Precisely. And maybe a fourth takeaway.
Go for it.
For a truly deeper understanding, you need to look beyond just the headlines and the simple news summaries.
It's deeper than the surface level.
Exactly. Don't just read that F&F and TaylorMade are in a dispute. Try to dig into the underlying contractual complexities, like what a right of first refusal or a consent right actually means. Understand why these clauses are so powerful and how they can shape the future of major brands, sometimes years after an initial investment.
So understand the mechanics behind the headlines.
Yes. And similarly, consider the real-world tangible impact of tariffs. Think about those complex global supply chains, the headaches for retailers trying to plan for the holidays under all this uncertainty, or how a tariff on foreign goods can indirectly hurt domestic producers by just dampening overall demand.
It's about seeing those intricate threads that connect seemingly unrelated events and really understanding the why behind the what, not just the what.
Couldn't have said it better. Ultimately, in a week like this, packed with high-stakes earnings, critical trade policy updates, compelling corporate drama, distinguishing between just noise and truly critical market signals is paramount if you want to stay genuinely well-informed.
It's about cultivating that critical thinking muscle, isn't it?
Mhm.
Looking for the deeper story, the underlying drivers.
That ability to discern, to analyze, is perhaps the most valuable takeaway for any learner in this information-rich and often overwhelming market environment we're in.
Well, we've truly taken a deep dive today, haven't we? Unpacking that explosive start to earnings season, the escalating tensions in global trade with that looming August 1st tariff deadline, and how companies are navigating these really complex waters through strategic pivots and even these high-stakes legal battles.
It's been a lot, and it's a vivid reminder of just how interconnected our global economy really is and how quickly new challenges can emerge and completely reshape market dynamics.
Absolutely. So here's something to think about. As global supply chains continue to grapple with these political shifts and this ongoing trade uncertainty, what does this tension, this constant push and pull between economic growth and protectionist policies, what does it mean for the long-term resilience of international business? And maybe, how might industries need to further adapt to what feels like an increasingly unpredictable world, one that demands both agility and real foresight? That's something for you to mull over long after this deep dive concludes.
Great food for thought.
For daily updates and quick stock tips, follow us on Spotify. This is Theta Fuse, where your money meets momentum.